The Grinch parameter is nearly coming to a close, and how we trade tomorrow could determine what happens for the rest of 2024. So what does that mean for your portfolios over the next 12 months? Today, we discuss that along with treasury auctions. Bond buyers are back, but will they continue to buy in the face of the macro environment? And we also need to talk about Apple. It's the biggest stock in the world, and it determines the flows for some of the biggest ETFs in the world. And as patent infringements threaten up to 10% of the yearly revenue, we need to discuss how to hedge. So as the S&P 500 makes a slow crawl to new all-time highs and bullish exhaustion sets in, we need to talk about what happens next. Hello ladies and gentlemen, welcome to the Daily Recap Show. My name is Chase. We do these videos every single day talking about stocks and the financial markets. If you like this video, please subscribe, hit the notification bell, leave a like. Let's get into it. It was quite the mixed day today. Apple, with everything going on with their smartwatch, you'd think they'd be down in the dumps, but they're holding in there. Tesla going for that breakout everyone's looking at, but it was a very mixed day. Energy as a whole was down. It was general broad-based buying across everything, a lot of risk on sectors. Software and semiconductors did do pretty well. All in all, a very mixed day. And looking at the majors, small caps and large caps were the real winners here. You can see, look at the IWM, up 0.35% after a 1.8% day yesterday. And the S&P 500 and Nasdaq also put up pretty good days. And you see this massive ramp up right here. That is theta decay, charm flows in zero DTEs. And zero DTEs is creating a lot of volatility. The beta on that is so much higher than the S&P 500 and the Nasdaq. And we got this week's sentiment poll, guys, the Christmas poll. 184 votes. Thank you, everybody. 54% of you guys are bullish, and it does look like we're going that way. The market is sort of just drifting higher. Quite a number of you are bearish as well. Maybe the bears show their heads tomorrow or the day after. But here are the sectors as a whole. GDX, the best performing sector, but it was fairly mixed. And we've seen this over the last couple of days. There's no real leader in sectors. It's sort of like regional banks are down today, up yesterday. GDX down yesterday, up today. We're sort of seeing this rotation between the sectors, but all in all, each sector is making higher highs, except energy. Have a look at the last quarter, down 5%, where every other sector, almost every other sector, is up more than 5%. And the two best performing sectors this quarter, regional banks and home builders. And as we have rallied this quarter, fund managers have followed. Fund managers are now 97% exposed to equities, and this is a really, really good sign. This shows confidence moving forward, because we can see that when the NAM index has gotten to above 90, we normally even see positive returns 1 week later, 2 weeks later, all the way to 1 year later, seeing upward of 11.48%, 76% hit rate, and median returns of 14.48%. But looking near term, we could expect a pullback in the next 2 days. The Santa rally is officially up 0.73%. We've had 3 positive days in a row, and normally we have 1 to 2 negative days in this period. We have 1 negative day in the new year and 1 negative day before the new year, and we could see a negative day tomorrow and the day after, and that could present a good pullback for the rally that could come on the 1st of January, which is normally a very, very positive day. And that's why we normally get a bunch of red days in the last couple of days of the year. Pension funds have to rebalance and reallocate their portfolios. This happened in 2022. It's going to happen again, and it has to do with this annual allocation. It's a big one. They have to balance their annual allocation, their quarterly and their monthly. That's why we do see quite a bit of selling, but there was a lot of selling happening under the hood in the S&P 500 today, and it really held up there. It really did. And one thing pension funds are also doing is buying treasuries. We had a 2-year note and a 5-year note auction today, and they fared far better than expected. The $58 billion sale was awarded at 3.801% after trading at 3.185%, and that is why treasuries absolutely dumped across the curve, and the 30-year, 20-year especially. But look at the 10-year below the 3.8 handle. The 3.8 handle provided significant support, and it actually broke it. Very crazy stuff right there. I would love to see the 20-year break the 4% handle. It's about 10 basis points away, and this is going to be really supportive for small caps and mid caps looking forward into the new year. And the market is now anticipating 7 rate cuts. The market is expecting to get to this level right here, 350 to 375 basis points as the federal funds rate. Very, very ambitious from the market participants right there. And I do think the market is getting a bit ahead of itself because we are priced to perfection. So this is Goldman Sachs portfolio strategy, and this is the consensus, right? So the consensus have 2024 earnings at 245 earnings per share, and Goldman Sachs have it at 237. If we meet in the middle here at 241, multiplied by a 20 PE, where we are right now, you get 48.20. So the market is slightly undervalued. This is fair value for the S&P 500. I do think a 20 PE is fair value. If you do use the 245 target, you could see 4,900 as fair value. So the market, you could say the market is maybe 120, 110 points undervalued compared to 245. But that's if 245 materializes. Using 241, you actually get a little bit of margin of safety in this price here. Now, if the market is priced to perfection, how would you hedge expecting a pullback, trying to capitalize on maybe a 5 to 10% drawdown? This is actually how I hedge my portfolios, and I use futures. We're going to go through the entire process. Firstly, we need to decide on the size of the portfolio. So we're just going to use a round number. We're going to use $1 million. You have a $1 million portfolio in the S&P 500. So you've bought $1 million in SPY shares. That's your portfolio value. Your beta is 1. The S&P 500 index currently trades at 47.87, a contract value of 50. In the futures, it's either 250 or 50. We're just going to use the 50, but I'll show you how to do both. And your target beta is 0. So if your portfolio is heavily on tech, you might do Nasdaq. So, and this is the calculation you use. And essentially what this number spits out is how many contracts you want to short. It's quite simple. So you're going to go your target beta minus your beta multiplied by your portfolio value divided by the S&P 500 index divided by the contracts. You just want to put this into Google Sheets or Excel, and then you're going to spit out a number right here. And this is the amount of contracts you want to hedge. Now, so here we are in the S&P 500 futures, the SPX. Now, this is the March contract. I actually like to use the cash instead. So you would then go to the $50 contract, put in your size right here of 4.17, which we just calculated. It would be on the short side, you would sell. And now let's say you were looking for a 5 to 10% drop in the S&P 500. So you just go to the daily chart. This is a year-to-date chart. So you're looking for a 5 to 10% drop. The current price is 47.91. You would then add 479 points to your limit. And you could see right here that your $1 million portfolio would be hedged by 10%, because if the index was to fall 10%, you'd make close, just under $100,000. And that's how you hedge your portfolio. And by doing this, for every 1% increase in your portfolio would be a 1% decrease in your hedge, and your delta would be completely neutral. You could also scale into contracts over like a 4-week period by one contract every single week. And that's probably what I'll do when I start hedging my portfolio. But it's not something I'm looking at right now. It's something I'm looking at probably 1 to 2 weeks in the future. If the macro environment and the technicals all align, I will keep you guys 100% updated with how I'm looking towards my short. But as it stands right now, this is just a hedge protecting my longer term portfolio. Now, that is your hedging strategy. I hope that really helped you guys in terms of futures hedging. Maybe tomorrow or the day after we'll cover how to hedge with options. Now, outside of the US, where can you find value? So we can see that the US right now is a 20 PE. This is the S&P 500. Excluding big tech, the S&P 500 actually just trades at 17.3. Fairly reasonable, all things considered. You are getting quite a number of great companies. But if you actually have a look at something like Japan, you are trading at a 14 PE and some great companies in the Nikkei 225. That's a great index. Also, have a look at emerging markets. I think the Indian stock market, the Nifty 50, just hit new all-time highs. And if you want a developed market, you can look at the UK. Now, what are BofA's private clients buying? Well, you can see here the number one thing they're buying is Japan. They really like Japan, like I just showed you guys before, and low volatility. And they're also buying municipal bonds, investment grade bonds, emerging market debt, and value stocks as a whole. Very, very interesting right here. TIPS saw outflows, which means people are sort of coming around to the fact that inflation might actually be lower in the next year, and maybe even at that Fed's 2% target. But this is just BofA's private clients. But let's switch gears and talk about the Grinch parameter, something we've been talking about for a while. Tomorrow is the last day. We currently are up 0.28% on the Grinch parameter, and what we want is a red day tomorrow. If we can get a red day, maybe get this slightly in the negative, that would be awesome, because a negative Grinch year often coincides with a positive January and a positive year. And every time we've had a positive Grinch, we've seen double-digit S&P 500 down years, except one, 1969. So we do want a negative Grinch. For those of you that don't know, the Grinch is just 3 days before Christmas and the 3 days after Christmas and the subsequent return. Let's move on and talk about Apple. Apple is going through some pretty rough court appeals right now. They recently just won a court appeal. It was a slight win for Apple, but things are not looking good. And let's go ahead and read this why. So Apple earned a small win in its ongoing patent battle with Massimo on Wednesday when a US appeals court paused an import ban on the company's smartwatches. Apple halted sales of its Series 9 and Ultra 2 watches earlier this month in response to an International Trade Commission order that ruled its blood oxygen sensors infringed on intellectual property from a medical device company. This company, Massimo, is saying that Apple used its blood oxygen sensor in their Series 9 and Ultra 2 Apple Watch, and the shares were slightly up today, plus 0.07%, and they're really holding in there, all things considered. Let's actually dig a bit deeper. Let's look at their revenue segmentation, and you can see here that the Apple Watch fits under wearables, home, and accessory. It's about 9 billion, just under $10 billion per quarter of revenue for Apple, and the Apple Watch accounts from anywhere from 30 to 40% of wearable revenue. And you can see here that all in all, wearables and home accessories is 10% of Apple's total revenue. So Apple's total revenue was about $383 billion. So about $38.3 billion is this wearables and home accessories revenue right there. This is the actual watch, the Ultra 9 and Series 2 watch that Apple are no longer selling. And this is how it's going to affect their revenue. According to Goldman Sachs, they predict it's going to impact about 2% of total revenues for the upcoming year. Each week that Apple can't sell the Series 9 and Ultra 2 in the US, it'll lose about $135 million in revenue. Now, Apple can't sell the stock of its Series 9 and Ultra 2 in their stores, but retailers who have existing stock can. So those retailers can still sell their stock, and Apple can still sell their SE model, which doesn't have the blood oxygen monitor. This is kind of a big deal for Apple because if you actually look at their last 4 quarters, it actually had negative growth in their last 4 quarters. So the company hasn't grown for over a year. The last quarter of growth was September 2022, literally a year ago. You can see a slight decline in their revenues, and this is coming off a 5-year compounded annual growth rate of 8% and 12% over the last 3 years. Now guys, this is not a short signal because Apple is a highly efficient company. Look at this, 42% return on invested capital, 56% return on capital employed. Just nutty stuff right here. These two metrics, when I look at really long-term investments, I look at these two and I actually filter for return on invested capital, right, of above 15%. And to see this is absolutely wild. And you can see, look at their gross margins, their free cash flow margin. They're just a cash producing machine. And that's because once you have an iPhone, you're locked in, and Apple know how to monetize that. Guys, I want to stress that this is not a short signal, okay? I'm willing to bet that Apple is going to finish higher in 2024 than the current price, okay? Do not bet against this. To bet against Apple is to bet against America. Now, let's switch gears and talk about seasonality, and the market just keeps on going higher. We're sort of just like following this like trend line. It's exactly what we're doing. Higher highs, higher lows, and the reason why we got this dip right here actually had to do with something called the post-OPEX window of weakness. And normally post-OPEX week in March, June, September, and December is normally fairly negative. You can see here that December is the outlier, but it's not as positive as a day as some other weeks in the year. And you can see that the OPEX window of weakness, the week after options expiry, is normally negative on average in June and September and has a median negative return in March. And the hit rates are fairly low. It's not that great. Oftentimes when you do see like a sell-off during the post-OPEX week, that's normally a very good buy signal for the month after. Now looking at the gamma heat map, this is where we are right now, guys. We're at this level right here, at this level, and we're in positive gamma, which means dealers buy dips, sell rips, and we sort of just have this type of price action. Strong support is going to come at 47.20. Again, I sound like a broken record from yesterday, and about the 47.90 level right here. And if we do get above this 47.90 into the 4800 level, it's probably a moonshot to 48.20 very, very quickly. And this sort of is the fair value price for the S&P 500 according to 241 multiplied by a 20 PE is equal to 48.20. We could get there. The market always wants to trade at its fair value, but as it stands right now, as long as we're in this section right here, higher highs, higher lows will keep coming. There'll be volatility, of course, but that is the expectation. And something that's going to help support this is probably CTAs. Now, you might look at this chart and think that CTAs are overstretched, but they tend to overshoot on the upside and the downside. Have a look right here. On the upside, CTAs were chasing and they overshot the S&P 500 price. CTAs are this green bar. Same thing happened right here. Same thing happened right here. And even on the downside, CTAs overshoot on the downside. They overshot on the downside right here. What do we expect? We could probably expect them to be capitulatory buyers over the next 3 to 4 days. Overshoot the S&P 500 will bring more buying action to the market. Now, let's have a look at charts. The S&P 500, bullish. Not much to say here. I've already spoken about it in the gamma heat map where I think we're going. Looking at the IWM, it's broken above this range right here. It looks strong. I think we're going to 212. It wants to see 212. That's where the next very strong level of resistance is going to come. And it's not too far. And that's, I gave you guys the IWM at 169. I said buy there on my Twitter. That's absolutely crazy. Look at this rally we've had. Looking at the XLK, this is very strong. You don't want to fight this trend, guys. Like, this is like substantial higher highs, higher lows. It just keeps drifting higher. I think all dips will be bought above this 177 area. Looking at TLT, yesterday I said we were above the 200 moving average. I apologize, that was a mistake. We are not, but we had a very strong day in the TLT, 1.77%. And the bond auctions, based on everything, we're probably going to go higher in bonds. And what I really want to see TLT do is retake this 200 moving average. I do have a very early Q1 price target for bonds for the TLT at 109. I'm currently in TLT, guys. My average buy price is about here. It's about 87-ish, about 87, 88. What TLT really needs to do is just retake that 200 moving average. It does that, and I think a lot of CTAs and algos are going to start coming into this. One thing I want to show you guys as well is we've seen massive trades at this 99 area, and we finally broke above. And if these are shorts, a lot of these guys are going to want to cover for even, so we're going to see a lot of support above here. But what I think it is just pension funds buying bonds, locking in yields, and this is why we're seeing this type of price action in the TLT. Looking at Tesla, maybe this breakout is coming. My personal opinion was that we're just going to bridge across here. We've had 2 very green days in Tesla, and what Tesla really needs to do is go and capture this 269 area, move higher from there. But as it stands right now, strength is building into Tesla, and it's not as overbought as you would think compared to the other Magnificent Seven names. Looking at Apple, and we can clearly see that there's been some sell side, not many people liking the news of the import ban and the smartwatch news. We'll have to see how the rest of the stock holds up. But all in all, if we are going to see extended selling activity in Apple, probably look towards this moving average. Apple is a very strong stock, and I do think they're going to rebound stronger off this news. Looking at gold, and gold is looking to break out again. I mean, we had a very volatile day right here, and it's sort of just been drifting up ever since. I think it wants to go take out those highs at 2150 and probably look to 2200. Looking at the VIX, VIX keeps getting crushed. These volatility selling strategies keep just capping the volatility to the downside, and maybe we go and retouch below the 12 handle again. But as it stands right now, I did post on my Twitter guide that if we saw stocks up, VIX up, that's going to lead to a blow off top with a massive VIX crush. But really what we do want is VIX above maybe the 14 or 15 level as stocks are going higher. We still have quite a lot of time before that happens, into the middle of January sometime then. Financials looks like they want to break out. They broke above the 3650 handle strongly, and now they've retested this line and they're looking like they want to push higher. I think there's just a little bit of accumulation going on. I do think financials are going to do very, very well in 2024. We could start looking at 39 and 40 handles for the XLF. Looking at Uber, it put up a very strong day. This is why 2.1%, like this chart, I'm actually waiting for a pullback to around the 50-52 level, but it might not ever come because it just looks super strong. This is a very, very strong chart. You don't fight this chart. It didn't even get to its 200 moving average. It just broke above it and rallied, pulled slightly back in this October time period. It's been an absolute runner ever since. Looking at NEO, this is potentially a play that could start to break out. I mean, if we get above this level right here, up, use as support, we could go ahead and tease this 13 level. It looks very similar to what happened right here. We broke above, came down, and had like a 50% run in just a couple of months. Could be very similar thing. History often does repeat. Looking at data in the week ahead, guys, not much data, just initial jobless claims. Pending home sales too, starting next week, January, that's when the data really pumps in, and we'll talk about that in the weekend video. But if you've made it up until here, thank you so much, guys. Appreciate your support. If you like this video, please subscribe, hit the notification bell, leave a comment,